Okay, so before you start this section of this review, I would recommend that you have gone ahead and gone through all these questions by yourself and selected answers, because if you just sit and watch me talking through the answers, it will probably most likely seem like these questions are all really easy and don't require a lot of thought, and you may get overconfident and then not do as well on the actual exam. So just make sure that you've already gone through and picked your answers by the time you watch this part. Okay, so we just have a few example questions from each chapter, starting with chapter 1. First question is that the basic purpose of a financial statement audit is to, and our first answers are detect fraud, detect material fraud. Clearly that's wrong. I wouldn't say this is the basic purpose of an audit. Really, that's to detect all misstatements. But if we don't have any other better answers, maybe we'll come back to B. Answer C, provide assurance regarding whether the auditee's financial statements are fairly stated. Okay, this is really the answer we wanted. Financial statements taken as a whole are fairly stated. That's in line with the basic purpose of an audit. It does encompass detection of material fraud, right? Because if the financial statements are fairly stated, it goes with that material fraud will have been detected. So that's definitely not the best answer. C is. And for completeness, let's read D. Assure the consistent application of correct accounting procedures. Okay, again, that is also going to be part of making sure the financial statements are fairly stated. So on its own, D is not the best answer. C is clearly the best answer, and it basically encompasses answers B and D. All right. Next question. In the context of agency theory, information asymmetry refers to the idea that, okay, so we have information can vary in reliability, information can vary in relevance. These are true statements, but they don't really have anything to do with agency theory or information asymmetry. C says management has more information about the entity's true financial position than do the absentee owners. Yes, this sounds like information asymmetry because management has an informational advantage over our absentee owners, which is going to create agency problems. So C is looking pretty good. D says management likely will not act in the best interest of the absentee owners. This is true, and it is part of agency theory, but it's not related to information asymmetry, which is what the question is asking. So we're left with answer C as our best answer. Okay, which of the following statements is true? A says independent standards are required for audits of public companies, but not for audits of private companies. All right, this guy is false because both have independent standards, but public company independent standards are stricter. It's not that they have them and private companies don't. So A is not a good answer. B, in corporations, information asymmetry between absentee owners and managers rarely or seldom happens. Okay, I know this is false as well. If this had said something like sole proprietorship, then the rest of the statement probably is okay and true, but in corporations, which is what the question is asking, there definitely are going to be problems. C, in corporations, conflicts of interest often arise between absentee owners and managers. Yes, this is going to be true. For completeness, attestation services are a type of auditing service. All right, that is false. To make this true, I could say auditing services are a type of attest service. So that would be true, but it's basically flip-flopped, so it's false. Okay, moving on to Chapter 2, the financial statement auditing environment. Okay. Post-SOX, the authoritative body designed to promulgate standards concerning a CPA's association with audited financial statements of an entity that is required to file financial statements with the SEC is, that was a mouthful. Post-SOX is an important statement here. An entity required to file financial statements with the SEC, we know that means it's a public company. And they're coming up with standards for auditing, basically. So post-SOX, coming up with auditing standards related to public company audits, that's going to be the PCAOB. All right, which of the following is not a requirement of the Sarbanes-Oxley Act? A, audit firms cannot provide most types of non-audit services to their public company auditees. This is true. That is a SOX requirement. Audit engagement firms are required to rotate audit partners off engagements every 5 years. Yes, we talked about partner rotation. So we said partner rotation happens, firm rotation does not. C, firms that audit public companies are subject to inspection by the PCAOB. Yep, we talked about PCAOB inspections and how terrified auditors tend to be of them. So that's true. Last, a certain number of hours, which is based on the size of the company being audited, must be spent on each audit engagement. So no, this is false. There's not any set number of hours that you have to spend on an audit, and we never discussed anything like that. So answer D is going to be our best choice here. This question asks about the responsibilities principle underlying an audit conducted in accordance with GAS and what that responsibilities principle says. It's interesting because this says responsible, which sounds like the responsibilities principle, but we know in that first section of principles underlying an audit conducted in accordance with GAS, it's called the purpose section, and that is where it said management's responsibility is X, the auditor's responsibility is Y. Answer D is no good because it says free from misstatement, which implies free from all misstatement, not material. So answer D is no good. And answer B, responsible for having appropriate competence and capabilities to perform an audit. Yes, this is consistent with the responsibilities section, so answer B is correct. Let's look at some questions now for Chapter 18. Before we start, this is kind of a question I have gotten from a student, and so I wanted to share it with everybody. This slide is a little bit misleading because in the title it says circumstances requiring an explanatory language in an additional paragraph. And then number 2 here basically says involvement of another auditor, which kind of implies this word require, that involving another auditor would require always an additional paragraph or explanatory language. But basically what it actually means, if you go on and you read the next slide, which talks about involvement of another auditor, you'll see you're required to mention them if you don't want to take responsibility for their work. But if you're okay with taking responsibility for their work, then it is okay not to mention them, and that extra explanatory language would not be required. All right, so moving on to the questions. The first is, which of the following parties is responsible for the fairness of the representations made in financial statements? So if we're talking about the financial statements themselves, management is responsible for those. Remember, the auditor is responsible for issuing an opinion on the fairness of representations made, but not the actually responsible for the fairness itself. We know audit committee is responsible for oversight, and so is the AICPA as a regulator. So next question, which of the following conditions or events most likely would cause an auditor to have substantial doubt about an entity's ability to continue as a going concern? So to kind of put this in my own words, the question is asking which one of these things will make the auditor think that the client is going bankrupt in the near future. So answer A, significant related party transactions are pervasive. This is not a great sign, but it doesn't necessarily indicate that the client is going to go bankrupt or is in poor financial health, etc. So I'm going to say not a bankruptcy indicator. Okay, B, usual trade credit from suppliers is denied. So this means people that are usually willing to let our client have AR accounts now say, no, actually you need to pay me in cash. And that probably is a sign that they're worried that they won't be able to pay them back if they do extend credit. So this is definitely a sign that the company is financially not doing very well. So this would be a pretty good indicator of possible going concern. Answer C is arrearages and preferred stock dividends are paid. Okay, so if they're going back, this basically means the company is going back and they've declared stock dividends in the past, but they haven't necessarily paid them. So now they're going back and they're so flush with cash, so lots of cash, that they are going to pay these preferred stock dividends that were previously declared out. So this generally happens if a company has plenty of cash on hand, which is kind of the opposite of a going concern issue. And okay, last but not least, we have restrictions on the disposal of principal assets that are present. So this is a good control that all companies should have, right? You shouldn't just be able to dispose of the asset without explaining it or getting approval. So this is a good control. It's normal. It's not some kind of sign of bankruptcy. So B was our best answer here. All right, due to a computer failure at its payroll service firm on 12/31, Frosty lost its December payroll, and as a result, auditor could not complete the payroll audit work, and Frosty did not keep the backup records, so the records can't be reconstructed. Okay, so this is pretty much the definition of a situation imposed scope limitation. So we know that because it's a scope limitation, we know that we're either going to wind up with a qualified or disclaimer opinion based on pervasiveness. So it says the December payroll expenses material. All right, so we know we're at least in material, but are we pervasively material? What type of audit report will be issued? Okay, so there's nothing here. It does indicate it's material, at least material, but there's nothing here to indicate we're in a pervasively material. Sorry, this is just, there's nothing here to indicate we're in a pervasively material situation. So therefore, or most likely is going to be qualified because, okay, we know it's material, but we're not seeing anything like that this is affecting other accounts, etc. So it seems like this issue is kind of contained just to payroll. And to be honest, like payroll expense typically is not the huge, like it is important, but it's not like cost of goods sold or anything. All right, so we can easily eliminate these because they're saying there's a gap departure, which there's not. You can easily eliminate E because adverse is not a opinion type associated with scope limitation. So you're really left with A and B, which is kind of this decision we were making here, which is going to be based on how pervasive the problem is, and it doesn't seem pervasive. So if I have to choose between A and B, I'm going to pick B and get rid of A. Okay, during the course of an audit of the financial statements of Excellent Corp, Smart CPA discovers the company's BP misrepresented one of the products before the FDA by falsifying test results. Unasserted claims, material in amount, are probable in the near future. Management refuses to include a liability for such claims, even though it's probable they'll occur and it's estimable. So what type of report should you issue here? This is basically going to be, and this are going to be a gap violation. Now we know if there's a gap violation, you're either going to have a qualified or adverse opinion, depending on whether or not the situation is material or pervasively material. So we can easily go ahead and eliminate C and D. A says either or, this is your options. And B says qualified opinion, but should not consider an adverse opinion. Okay, so I would only want to go with answer B if I am confident that this situation is not pervasively material. And I think the issue is, particularly if you're finding out that senior management of the company is basically committing fraud. So you found out they've committed fraud in one area. The problem with this is it can be kind of an indication or a red flag that there will be fraud in other areas, right? Generally, if this guy or girl was comfortable lying to the FDA and falsifying test results, it probably is not going to be an issue that just stops there. So because of that, there is definitely chance for an adverse opinion here. So A is a better answer than B. Okay, chapter 19. First two slides. Again, these are some questions that I got from students, and I thought the answers would be helpful for everybody. So the first asked kind of conceptually, why does the CPA commencing litigation against management considered an independence violation? Okay, so the basic explanation behind why this conceptually creates independence issues is because you are supposed to have, as an auditor, you are supposed to have a healthy working relationship with management. So you really should get along with them because you need to ask them for support. They need to be providing you with support. You don't want to create this adversarial relationship between the CPA and management where they're like gunning for each other and out to get each other, right? Because then the CPA wants revenge, right? They don't want to just give a fair opinion on the financial statements, and management wants to screw over the CPA, right? They don't want to help them by giving them supporting documentation for accounts. So it just basically will, if litigation is commenced, it will basically just ruin the relationship between CPA and management and cause kind of conflicting incentives and stuff like that. All right, the next question, which was why would unpaid fees from prior year compromise independence, conceptually speaking? Okay, so let's think about this a couple different ways. One way to think about it is, hey, if there's all these unpaid fees, the unpaid fees could be pretty material to the auditor. So I was saying, imagine a situation where an auditor only makes $5 million a year in fees, and they have a whole $1 million in fees waiting that are unpaid. So this creates a huge debt between the auditor and the company they're trying to audit, and the auditor basically becomes a debt holder for the company. And so their motivation really becomes about getting paid back their debt investment, not about making sure the financial statements are fairly stated, right? Imagine if there was a going concern issue. They don't want that client to go into bankruptcy because they may not get all their fees back. So they would now be incentivized to say everything looks okay because that gives them better potential to get that fee paid back. Another possible scenario that could cause problems would be if fees are unpaid, the client is struggling. Auditor basically thinks they're never going to get paid. So most of us, auditors included, are not going to do our best work, our highest quality work, if we don't think we're going to get paid at the end of the day, unless you're going out of your way and volunteering your time, right? But in a normal relationship where you should be getting paid, if you're not, you're going to be pretty resentful of that fact. You're not going to be wanting to do your best work. Okay, so now let's go into the questions for the chapter. So first one is, a CPA while performing an audit strives to achieve independence in appearance in order to what? All right, so the generally accepted standards of field work are more into making sure the auditor is complying with independence in fact, less concerned with independence in appearance. C says become independent in fact, which doesn't really make sense because independence in appearance and independence in fact are kind of two different facets of independence. You can't become independent in fact just by becoming independent in appearance, right? And A, reduced risk and liability has some potential depending on what answer D is. So answer D is maintain public confidence in the profession. So this is a clear answer for why you want independence in appearance. It should also have the side effect of reducing risk and liability, which will be helpful, right? Because it should reduce risk of litigation. And reduced risk of litigation should help make sure that public confidence is maintained in the profession. But A is really more an indirect reason why you want to have independence in appearance. Really, the main direct reason is to maintain public confidence in the profession. Okay, which of these circumstances would the independence not be considered to be impaired? So in this case, the CPA has been retained as auditor of a brokerage firm, which owes the CPA audit fees for more than 1 year. So we know prior year audit fees cause an independence issue. So A shouldn't be the answer. B, in which the CPA has a large active margin account. So that would be a direct financial interest, which is an independence violation. In which the CPA's brother is the controller. So we talked about close relationships that can cause independence issues. And one is if you have a sibling in a key role at the company. So this is an independence issue. And D, which owes the CPA audit fees for current year services, okay, and has just filed a petition for bankruptcy. Right? There is nothing wrong here with D. And I also want to point out that if you owe, right, we know if you owe prior year services that it's a problem, that causes an independence problem. But generally, if you owe for prior year services and you've filed for bankruptcy, it is not considered an independence violation, basically because as part of the bankruptcy proceedings, all your debts will get wiped out, right? Because your various creditors will get paid off. So if you've gone through bankruptcy proceedings, the prior year unpaid fees are actually okay. But this is asking about current year fees anyway, so it would actually be good regardless of whether or not there's a bankruptcy petition there. Okay, which of the following statements best describes why the profession of CPAs has deemed it essential to promulgate a code of conduct and establish a mechanism for enforcing observance of the code. All right, this one I'm not going to go over too much because it is basically on slide 1 or slide 2 of those chapter 19 slides, and the wording is all exactly the same. So if you got this one wrong, I would just go back and read those first few slides of the chapter. You'll see there's a slide saying, why do we have a code of conduct? And the answer is literally this. Auditor Ernst & Old's independence is most clearly lost when. So A says, Ernst & Old audits competitor companies in the same industry. All right, this is actually not an issue and independence-wise, and would probably give the auditor industry expertise, so it's actually kind of a good thing. B, when EO's independent review partner disagrees with a client regarding key accounting policies, the audit client complains to EO's head office about the partner's quote-unquote cynicism, and EO removes him from the client. All right, so it seems here like the independent review partner, whose job it is to kind of challenge concerning accounting policies and maintain the firm's independence. So this partner was fired effectively from the client because the client complained to the head office. So this does look like something fishy is going on because the head office is just basically following the client's orders instead of making a priority like the actual fairness of the financial statements. So this does seem like independence has been impaired. So again, they're not like breaking a specific independence rule we talked about here, but you can tell based on the situation that some lapse in independence has occurred. And this example is actually an Enron example, or it's one of the many things that went wrong there. So C says EO issues a clean audit opinion, but the independent review partner fails to notice that the staff auditor's observation of inventory was horribly incomplete. All right, this is incompetence, but not a violation of independence. And D is actually the same thing. It's basically saying the audit team failed to discover or notice the client had omitted a key disclosure. So again, this is incompetence, but it's not impaired independence. All right, now let's talk about Chapter 3. In assessing whether to accept a client for an audit engagement, a CPA should consider. All right, so the current financial health of the prospective client will kind of speak to engagement risk. So this could be relevant. Integrity of management also can speak to engagement risk. So that could be relevant. C, the overall engagement risk. Yes, we need to know that to help us figure out whether we want this client or not. So C is a very good answer. D, all of these should be considered. Yes. All right, now if answer D did not exist, by far the best answer out of these three would have been answer C, right? Because C encompasses both A and B and more. D works because it gives us the ability to say, yeah, A through C are all relevant, but were it not there, answer C is by far the best of these choices. Right. Evaluating a prospective client requires which of the following steps? Right. So keep in mind, this is a prospective client, so we haven't yet accepted this audit, done the engagement letter, etc. So, okay, A is communicate with predecessor auditor. We know that this is true. There's no need to pre-plan the audit. So pre-planning the audit would involve like risk assessments and stuff like that. And generally you have not gotten that far if they're not yet a client. And C is establish the terms of the engagement. This basically means you've done the engagement letter, which we know if we have the engagement letter, they are your client. They're not just a prospective client. So C does not work, but A is a good answer here. Okay, which of the following ultimately determines the specific audit procedures necessary to provide an independent auditor with a reasonable basis for expression of opinion? Okay, this is a little bit of a trick question. Yeah, not really, but the word ultimately is very important here because, yes, your audit plan, your auditing standards, materiality, your documentation should all basically be indicating to you when you're ready to provide a reasonable basis to your opinion. But what ultimately determines if you're ready to issue that opinion, that will be professional judgment at the end of the day. So if you ever see any of these questions that are like at the end of the day, what ultimately determines this in the audit? And you see an answer choice that says professional judgment, it's a pretty safe bet that this is the answer choice for questions like these. Right. Which of the following should an auditor obtain from the predecessor auditor prior to accepting an audit engagement? Right. So this was a slide we kind of talked about required communications between the predecessor and successor auditor. And most of those communications surrounded one issue, which is trying to figure out if there are any concerns with management integrity. So answer D is our correct answer here. I mean, it would be fabulous if we could get C and even A and B, right? But what is essential before accepting a client is to figure out if there are any issues or concerns with management's integrity, because that is going to determine your engagement risk. All right, which of the following is not accurate with respect to the summary of audit differences threshold? Keep in mind that not. All right, A, any detected misstatement over the SAD threshold will be accumulated in the SAD. That is accurate, so A is not our answer. B, all account balances over SAD should be audited. This is not true. It's actually all account balances over TM/TE that should be audited. So answer B is looking pretty good. And C, it is usually calculated as 1 to 5% of materiality. That is also true. So answer B is our best answer here. And last but not least, some questions from Chapter 4. Which of the following best describes the concept of audit risk? Okay, A, the risk of the auditor being sued because of association with an auditee. This is really litigation risk, which is a type of engagement risk. We know engagement risk influences audit risk, but the question is which of these best describes the concept of audit risk, which A really does not. B, the risk that the auditor will provide an unqualified opinion on financial statements that are in fact materially misstated. Yes, this is a very accurate description of audit risk. C, the overall risk that a misstatement exists in the financial statements. This is describing RMM, or risk of material misstatement. And D, the risk that auditors use audit procedures that are inappropriate. This is describing an element of detection risk. So B is going to be our best answer. Okay, next question. An auditor learns that a client's employee in control of inventory gets divorced and is responsible for paying a large amount of child support. All the following are true except, okay. So this was kind of discussed in conjunction with the fraud triangle, and specifically risk factors for risk of misappropriation of assets. And this was talked about as something that would create an incentive for risk of misappropriation. So all the following are true except, okay, we know fraud risk increases. That is true. Risk of misappropriation of assets increases. That is true. So we talked about, even though IR and CR are generally defined as RMM, that fraud risk also impacts RMM, that it's a distinct type of risk Fraud risk can sometimes influence RMM by influencing inherent risk, but it is also considered its own separate risk concept, and it can influence RMM directly. All right, risk of material misstatements increases. Yes, so we know if a fraud risk is present, that RMM increases. And lastly, detection risk increases. Well, we know if RMM is increasing, that detection risk should be decreasing, meaning the auditor is doing more work. So answer D is in opposition with that. So answer D is our false answer, since this is an except for question. Okay, which of the following procedures would not be used to obtain an understanding of the entity and its environment? All right, so keep in mind this is going to happen during kind of planning phase of the audit. So observation, yes, something we talked about. Reperformance is okay because we talked about this idea of how you do walkthroughs during planning, and that'll involve reperformance. Reviewing prior year audit documentation, that sounds pretty normal. And then C is to verify proper valuation of inventory. This is verifying a balance sheet balance, verifying the correctness of a balance sheet balance, and that would be considered a substantive procedure, which is going to happen long after the planning phase of the audit, right? Substantive procedures happen towards the end of the audit. So C is the procedure that would not be used, right? Which of the following would cause you to decrease detection risk? So we know an increase in CR means an increase in RMM, which means a decrease in detection risk. So A is looking pretty good. B, a decrease in inherent risk. So by the same standard, we know this answer is not going to work. C is an increase in engagement risk. So if engagement risk goes up, I know that means my audit risk is going to go down as a result. And I know audit risk and detection risk have a direct relationship, so detection risk will also go down. So in terms of which caused detection risk to decrease, A does, C does. So looking at answer E here as our best answer. Right. During Madoff's Ponzi scheme, the SEC failed to build a case and come up with a smoking gun. Any examinations the SEC conducted fell drastically short. SEC's ineffectiveness in this case exemplifies what? So their ineffectiveness basically is ineffective monitoring / regulation, which is going to be a risk factor for opportunity, right? Because this is basically like poor entity level controls or poor controls at the highest possible level, right? And that the regulators are ineffective, that there's no external monitoring taking place. And that opens up opportunities, right? And that is it for our review session today.